Hello everyone, welcome back to Finance Unpacked with SB. Today we are going to learn about the repo rate. Recently, HDFC was in news where it was the first bank to cut their savings bank interest rate from 3% to 2.75%, which was followed after RBI has cut their repo rate by 25 basis points in their April 9th MPC meeting. So what exactly is repo rate and what is reverse repo rate? To simply put, repo rate is the rate at which commercial banks borrow from RBI, and reverse repo rate is the rate at which RBI borrows from the commercial bank. So how does this transaction occur and what is its significance? Let's try to understand that. See, commercial banks have some securities, government securities with them. Let's suppose HDFC have a government security valued at ₹100 with it. He sells it to RBI, okay? RBI takes it at ₹100, and so RBI takes the treasury bills, government take the government securities and give ₹100 to HDFC. But they have an agreement that HDFC will repurchase these securities after 15 days for ₹106. So now, basically what is happening is RBI has borrowed HDFC has borrowed ₹100 from RBI for 15 days, for which it is paying 6% interest in the form of ₹6 extra that he has to pay. Whereas if HDFC has excess cash, let's suppose they have cash of ₹200 and they say, hello RBI, please keep it with you and give me some interest. And RBI says, okay, that's fine, I'll give you 5.75% interest on whatever the securities you put up with me. So it is the same situation. In that case, the commercial banks purchase the securities from RBI and provide them with the cash with an agreement to repurchase the securities by RBI at a predetermined interest rate. So that is all about repo rate and reverse repo rate. Now how does that control our economy? Basically, RBI used repo rates to control the liquidity or cash in the economy. How? If RBI wants to tackle inflation and they want to squeeze the money out of the economy, what they will do? They will increase the repo rate. Once they increase the repo rate, the loans will be more dearer to the commercial banks. That means they will be discouraged to borrow huge amounts from RBI. Whereas if RBI wants to increase the liquidity in the system, they want the growth to happen, they want the money to be with the commercial banks so they can loan it further and that money gets circulated in the economy in the form of infrastructure and business growth, then what RBI will do? They will decrease the repo rate. That means now the funds would be available to commercial banks more easily to lend it out. And that is how RBI controls the liquidity in the system through repo rate and reverse repo rate. Do let me know in the comment section what do you want to learn next. Do you want to learn about inflation? Do you want to learn about how repo rates affect your loan transactions or your savings bank and FD bank account interest rate? Or you want to understand how the repo rate transaction affect the bond market, right? Do let me in the comments and follow for more such videos. Thank you.